Hey folks, welcome back to Real Estate Investing Unmasked. Today we're going to answer a question that maybe some of you have as you started to look for investments to make online. You've looked at some real estate investments or maybe other investments as well. One of the questions that comes up is, what is an accredited investor? An accredited investor is essentially not the elite of investors per se. It really is the way that the SEC and FNRA, these government bodies, have decided that they can make a separation between a common investor and somebody who is a little bit more astute, somebody who has been a little bit wiser with their money, supposedly, somebody who they expect will do their research before they get into an investment. And if they lose their money, it's all on them. See, the SEC and FINRA, they're trying to protect the little guy, the guy that makes, $50,000 to $100,000 a year. They can invest in the stock market because they have a lot of regulation on the companies that are in the stock market. But when it comes to real estate and some of the other deals that are out there, lending, etc., for investors, these organizations want to make sure that the little guy is protected. The way they do that is they have a designation of an accredited investor and a non-accredited investor. Now, the return on your money for an accredited investor can be anywhere between 6% and 25%, and sometimes could be higher. And the higher the interest that you get back, the higher the risk that's involved. The lower the return, usually that means the lower the risk that you're taking. Now, a lot of accredited investors will purchase retail centers, office space, large multifamily properties, big centers like UPS facilities or FedEx facilities. They may even own post offices, things like that. They may be in groupings of people that buy farms where they can split up farms amongst several accredited investors. They could also invest in things as small as duplexes and triplexes or single family residences. Now, accredited investors, the idea is, like I said, that they're an astute investor. They're somebody who studied money or they've done very well in their life. There are essentially two main rules to become an accredited investor. Now, there are some exceptions to these rules, but for the most part, they are these two rules. The two rules are that you have a net worth of $1 million or more, and it does not include your personal residence. So that's step one. Step two is that you have an annual income of $200,000 a year if filing singly for the last 2 years, and expected to also make that $200,000 this year. If you're married filing jointly, the number is $300,000. Now those numbers do change, so you may want to keep up on that. And there are other exceptions. For instance, if you have a trust, a family trust that's worth $5 million, then the trust itself can be considered an accredited investor. So when you see that thing that says Accredited Investors Only, that's what it's talking about. It's basically saying you don't make enough money or you don't have enough money to take part in this investment. It could be a high rise and whatnot. So there's a lot of reasons why you could or could not be an accredited investor. Now, I can tell you that you do not have to be an accredited investor to make those same returns on your money, but you're likely to have to find deals on your own. All the investors that I know that go and look for money elsewhere, they often go to accredited investors and have a whole package that they're displaying to these folks. Whereas if you have money, you've got lots of money that you've saved up, but it's not the $1 million, you aren't making $200,000 a year, but you've got money to invest and you don't know where to put it, you have to be a lot more choosy in it. And the people that have those options available to you, they may be riskier. So you just want to make sure you're doing your due diligence if you're not an accredited investor. And if you are an accredited investor, you better be doing your due diligence because you have a lot more money to lose. It doesn't matter how much money is lost. If somebody has $10,000 and that's all they've got to their name and they lose it, they lost their whole savings. If somebody has $5 million to their name and they lose it all, they've lost their whole savings. So in reality, it really doesn't matter too much. You want to do your due diligence. There are some crowdfundings that have been available because of changing the definition of accredited investor. One of the things that has come to fruition are things like Fundrise and some of the others that do provide ways for investors like you and me to come in with $100 or $500 or $10,000, whatever it is their minimum is, usually around $1,000 or so. It allows us to crowdfund and put that money together to buy multiple units. Now, I know Fundrise has been around for a couple of years, and you're welcome to take a look at Fundrise. I do not invest in Fundrise. I have sent emails to Fundrise to ask them questions about their business model, and I may do a video specifically on them someday. Speaking of that, if you have any questions about real estate investing, go ahead and ask them in the comments down below, or reach out to me at www.watchbob.youtube.com, and I'll be glad to steer you in the right direction to the best of my ability. So thanks guys for watching, and I'll see you next time.